Good morning, everyone. I'm Vince Lancy. It's Monday. Today's market rundown. We will be discussing, we'll be answering two questions. Will central banks continue to accumulate gold? And Goldman has an answer for that, as well as some other questions. And Apollo Bond Management. They handle a large portion of 401ks and retiree bonds, and they're always on the lookout for inflation, recession, what have you. They asked the question, well, is inflation reaccelerating? That's their question. And we're going to go into that. Before we do that, let's take a look at the markets. 10-year yields are down 2. The dollar is 107 spot even, up 5. The S&P 500 is 60.61, up 15. The VIX is 14.28. Gold is 26.62, up 14 and change on the highs of the evening. Silver is 30.65, up 10. Copper is 4.15, straddling unchanged on the offered side. WTI is 70.48, down 61. Natural gas is 3.05, down 9 cents, almost 9 cents. Bitcoin is 103,867, touching as high as 105 this weekend, down 649 right now. Ethereum is 39.18, also made a new, not a new high, but close to a new high over the weekend, 39.18. Palladium 949, unchanged. Platinum 922, down a little less than a buck. Gold, silver, strong at 86.80. Grains are soy is up 2 cents at 9.92. Corn is up a penny, almost 2 cents at 4.32. And wheat off your screen is 5.38, up 4 cents. Here's the homepage. We put up about 4 or 5 stories between Friday and today. The featured story is Goldman Central Bank's China doubled down on OTC gold buying. So Goldman had an extrapolation of what they thought will be the pullback in gold buying, but central banks, specifically China and Azerbaijan and a couple others, bought more than was expected. That might be why we had the strength the last 2 weeks. Trump tariff risks shake gold and silver market. That's almost old news right now. And CFTC preparation for the discussion that we have over the weekend. We're going to touch on that in a minute. First, let's go to the main story, the first story. Goldman put out a report late last week. They have a system called Nowcast. And Nowcast basically is an accumulation of data that shows over-the-counter gold bullion activity in London out of Switzerland. And they were surprised with the amount of gold that was purchased in October. This is after China came back online in September and bought publicly. And they go through their response to it in a Q&A fashion. So let me start with the description of the report. In this precious comment, we share our latest October GS Nowcast of central bank and other institutional gold demand on the London OTC market, where most central bank purchases occur, including both reported and unreported activity, and address why we believe this trend is set to continue. And the story is from Goldman Central Bank's China purchases. Here's the chart in question that alerted me to the importance of this. The red dotted line is their prediction of the decrease in gold purchases. So the blue line is actual gold purchases through the London OTC market, not even the futures, London OTC. And they predicted that it would slope off. Well, it's well above their expectations of sloping off. So that's important because the market had already begun discounting a decrease in purchases, which would imply a lower price. To the next part of it, share a little bit more with you. They ask 4 questions, right? Question 1, how much gold have central banks purchased in October on the London OTC market? They answer that, and it's more than they thought. Question two, why are central banks now buying so much gold? That's a reframing of what we all know, but some people may not know. Question three, will central banks continue to accumulate gold? And they answer that. We'll give you that answer in a second. Q4, what are the implications of the strong Goldman Sachs central bank nowcast for your 3,000 price per ounce and 2025 gold forecast? Well, the last one I'll tell you that is bullish. There's now upside risk to their forecast. There's always downside risk, but now there's upside risk. The question three, we want to share a piece of the answer with you because it brings home uh, a bigger picture point. Will central banks continue to accumulate gold? This is their answer. Yes. Even if Russia's central bank assets were to be unfrozen, the 2022 freeze precedent has reshaped how central banks view tail risks. Moreover, China and EM central banks tend to hold relatively small shares of their reserves in reported gold compared to their developed market counterparts, leaving significant room for growth. Now, before we look at the chart, which is going to help you with the big picture, we've been saying this for about almost 2 years. And what they call tail risks, or what any finance person would call tail risks, are really a lack of trust, right? The assumption was you would not have your assets frozen. The assumption was money was outside of geopolitical risk, as it was during previous wars. However, when the U.S. confiscated their assets, that increased the risk of everyone doing this. And if everyone's doing that, if everyone's worried about that happening to them, then everyone's going to be less interested in putting their money in an asset that can be confiscated. There's counterparty risk. Counterparty risk was valued lower until the Russian attack. Now it was valued higher. So that's the first point. So even if the gold were given back, the trust is broken permanently. Hence the concept of mercantilism. Mercantilism exists because there's a lack of trust, and you can't put that genie back in the bottle. You have to earn it back over time. Trust is to use an analogy that was shared with me, trust is a ball of yarn being rolled up, and as soon as you mess up, it takes a long time to roll it back up again. Crazy analogy, but there you go. The second part is actually bigger picture, and I think this chart that I have here uh, underlines that. Moreover, China and other EM central banks tend to hold relatively small shares of their reserves in reported gold compared to their developed market counterparts, leaving significant room for growth. All right, so depending on how you measure it, developed markets, the G7, we have more gold in our reserves uh, for counterparty risk and for trade than developing markets do. Or we'll just call it the BRICS, right? Well, first of all, that's true. Second of all, it might not be as obvious. It might not be as true as people think. So the story is we have more gold than them. The truth is our gold hasn't been audited. The story is they don't have that much gold. The truth is they're buying a lot more than they say. So I'll give you my point here. The red is China's PBOC buying gold. That's them, their central bank announcing that they're buying gold. The blue is gold being bought by China, not through their central bank. Now, how can they do that? Well, first of all, this is they have an army, and the army is not on the balance sheet of the country. The army has its own balance sheet, and so the army buys gold. Other entities like Safe buy gold in China, and here's the thing: um, when the West changed gold from money to a collectible item, it's a it's a piece of art. They made it a thing. And when they made it a thing, you don't have to report it as monetary reserves anymore. So much of this gold being bought that's not going to PBOC is being held as non-monetary item. It's being held as a commodity. Well, you guys called it a commodity. I guess we'll just buy it as a commodity and we don't have to report it. And so China and other countries, China is the easiest one to see, have been buying way more than they say. And take a look at 2016 versus 2024. In 2016, if you add that all up, basically they bought publicly what they bought privately with a big spike before 2016, 2015. And that was part of them joining a world organization. They wanted to make a show of that. And then between 2018 and 2024, the purchase of gold publicly is about one third to one half of what's being purchased privately. So out of every 1,000 tons, 660 is being bought privately, not being declared. So to say that China and countries like China have only 5%, which is what a lot of people imply, of their reserves in gold is officially true, right? But the reality of it is they have a lot more gold, and all they have to do is take it from one entity and put it in another and say, this is now monetary gold. And you could also do that with silver, which I think will happen at some point. Uh, anyway, that's it. That's the report. There's a lot more in the report. Here we go. While developed markets like the US, France, Germany, and Italy hold about 70% of their reserves in gold, China, the world's second largest economy, reports just 5%. Just a quick note. Statisticians and Western financial people love to talk about how much gold is in their reserves as a percentage of reserves. What these countries are doing and not telling everyone is the better target is how much of their GDP is in reserve. So if you have an economy that's say 5% GDP or whatever your GDP is in actual dollars or monetary units, what percentage of your GDP is in gold? Because your GDP dictates your trade volumes. If you have a small country, then you're not really selling a lot of stuff. You're not really buying a lot of stuff. If you have big GDP, well, then you have a lot of trade. So it's kind of like your house is your asset, that's your GDP, and your gold is your liquidity. That's how you get trade done. So your money market is your gold in this sense. So people talk about gold as a percentage of FX reserves. No, these countries in Europe, especially, are targeting gold as a percentage of GDP. You're going to hear more about that in the future, but only after they decide to share that with us. We have the rest of that report in detail for premium subscribers. Moving on, news and analysis. That's the report we just touched on. Hartnett using HELOCs to buy U.S. bonds coming. Now that wasn't the focus of his report. His report was focused on how much more debt that we're going to be having, more debt under Trump. Okay, in the first 2 years, and that will lead to more inflation if his plan doesn't succeed. Uh, that's the gist of the whole thing. But there's a phrase that keeps creeping into Hartnett's work, and this is like the third time out of 5 reports, and he's discussing a way to unlock home equity to pay down the deficit. And what it essentially is they're talking about Bank of America is very interested in the concept of a HELOC, a government-sponsored HELOC, to buy U.S. bonds, and it's something they're going to consider. And it's something they might do because history says that they would do something like that. All right, 2 p.m. Sunday CFTC discussion prep. That's a prep. We'll have the actual video going out today. But what we uncovered during that conversation was bullion banks are operating normally. They're not at 100%, but they're selling when it rallies. They weren't selling when it rallied before the election. And they're also getting involved in options. That'll tell you that it won't be straight up from here. And we're after the events. You should expect that. And China's Forex reserves should move away from the US dollar. That's a story we've heard before, but it's significant because this guy is respected, and he's one of the reasons that we think that China bought. Founders, China doubles down. That's the actual PDF. Moving on, politics, geopolitics. We just like to draw your attention to Yellen said the Treasury continues to warn China about the potential for bank sanctions over transactions aiding Russia's war effort in Ukraine and will not rule out sanctions on Chinese banks. Okay, that's like telling them to go out and buy more gold. That's what they're telling them, right? And it's almost like Yellen is trying to make Trump's uh, life as hard as it can be, even though he's threatening to sanction them as well. So the more you do this, this guy says the more gold they should buy. And that's it. And here we are 2 months after that guy said that, almost 2 months. And she's saying it again. So what do you expect is going to happen? Data on deck this week is the FOMC. December 18th is the FOMC. Things can change between now and then, but right now, the marketplace in general, gold included, is assuming that the Fed will cut on December 18th, and then assuming that the Fed will talk like they will probably not cut more going down the road. So banks, which had been euphoric, calling for 3, 5 cuts in 2025, are now calling for December, January, and possibly no more. Uh, I just think it's the cycle of central bank of bank emotions. They just say a lot of cuts, a little cuts, and the Fed just doesn't really care what they say. But I would say that it affects the gold market in a pronounced way. So for example, that second inflationary report, CPI, came out last week, right? And it was hot and gold was okay, right? And then PPI came out and it was super hot and gold just dove. Well, that's that American hot money going, oh, inflation's high. We're not going to get a Fed rate cut. Let's put our money in dollars, take our money out of gold, and boom. That's what they do. Don't ask me why stocks keep going up. Well, I mean, I could tell you why, but it wouldn't make sense. All right, so Fed Open Market Committee is the focus this week, but there's other data as well. Quickly to touch on Apollo. Apollo asks a question: is inflation rising again? Upside risks or strong economic momentum. And there's their cover page. Here's the first slide. That's the 1970s analogy, right? Core CPI is in whatever that color is. I can't even tell. They use such muted colors because they don't want to confuse their elderly client base. But you have the 1970 analogy, and then you have uh, the core CPI currently as it's moving. I know here we are in 2025, and it has mirrored it pretty much almost to a T. The question is, are we here or are we down here? And will this happen? So I think it will happen, but there are plenty of charts to that effect. And here's little, a little, a little hint. When a firm asks a question for their title, is inflation rising again? In this case, if the answer after you read the report is yes, then the research is authentic. If the answer after the report is no, then they were just trying to get you excited to read a report that would make you happy until the reality is they're just not going to say it. So, long story short, is Joe Biden an alien? No, he's not an alien, but you'll click on that. Real reports, the answer is yes to a question like that. Anyway, that's your tip for the day. That's your how to read these things quickly for a day. All right, silver, here we are back again on the 50-day moving average, 100-day moving average, I should say, right? I am not happy with that, but I'm not incredibly bearish. I'll explain why in a second. Gold, similar situation, except that it's just breaking the 50-day. I think the 50-day average does not mean that much. I discussed this on Sunday's conversation. If you asked me where I thought the market would go, I'd say I'd be a buyer at 2,600 and I'd be a seller at 2728. So I'd be a seller at 2728 and then a buyer at 2730 because once it gets above here, I think it runs again. And I'd be a buyer at 2600 because I think this buyer will come back. I did not think this buyer would come back before, but I think the buyer will come back because the buyer is looking at the Chinese demand that has resurged, for lack of a better word. All right, that's it. I'm Vince. Have a great day.